Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that's absolutely critical for every swing trader, but often gets overlooked: risk management. You can have the best trading strategy in the world, but without solid risk management, you're essentially gambling with your hard-earned money. So, if you're serious about staying in the game and growing your account consistently, you need to stick around for this one. First things first, what exactly is risk management in swing trading? In simple terms, it's a set of rules and techniques you use to protect your capital from significant losses. It is not about avoiding losses altogether, because losses are a natural part of trading, but about controlling them so they don't wipe you out. It's your financial armor, your safety net. Think of it as the foundation of your trading house. Without a strong foundation, everything else will eventually crumble. So, let's get into the practical stuff. The first and most fundamental rule is the 1% rule. This is a classic for a reason. It means you should never risk more than 1% of your total trading capital on a single trade. For example, if you have a $10,000 account, the maximum you should be willing to lose on any one trade is $100. This might sound small, especially when you're feeling confident, but it's what keeps you solvent. It allows you to withstand a string of losses without blowing up your account. Remember, the market can be unpredictable. You could have 10 losing trades in a row. With the 1% rule, a 10-trade losing streak would only reduce your account by about 10%. Without it, you could be out of the game entirely. It's about longevity, not just one big win. Now, how do you actually implement the 1% rule? This brings us to our next crucial technique: determining your position size. Position sizing is just about how many shares you can buy. It's about how many shares you should buy based on your risk tolerance. To calculate this, you first need to know your entry price and your stop-loss price. The difference between these two is your risk per share. Let's say you want to buy a stock at $50 and you've identified a solid support level at $48. So, you place your stop-loss there. Your risk per share is $2. Now, using our $10,000 account example, we know our maximum risk for the trade is $100. To find your position size, you simply divide your max risk by your risk per share. So, $100 divided by $2 equals 50 shares. That's your position size. No more, no less. This calculation ensures that if the trade goes against you and hits your stop-loss, you only lose the $100 you are prepared to risk. It takes the guesswork and emotion out of the equation. Speaking of stop-losses, let's talk about them in more detail. A stop-loss is a preset order that automatically sells your position if the price drops to a certain level. It is your non-negotiable exit plan if a trade turns sour. The key here is to set your stop-loss based on technical analysis, not on an arbitrary percentage or dollar amount. Place it at a logical level, like just below a recent swing low, a key support level, or a significant moving average. Why? Because these are areas where the price structure of your trade idea is proven wrong. Placing it randomly means you could get stopped out by normal market noise, only to see the trade then move in your favor. And once you set that stop-loss, honor it. Moving your stop-loss further down because you're hoping the price will turn around is one of the biggest mistakes a trader can make. It's called hope buying, and it's a fast track to a margin call. Set it and forget it. On the flip side of a stop-loss is the take-profit target. This is just as important for managing your trade. Before you even enter a position, you should have an idea of where you plan to exit with a profit. This brings us to the concept of the risk-to-reward ratio. This ratio compares the potential profit of a trade to its potential loss. For swing trading, a healthy risk-to-reward ratio is generally at least 1 to 2. Meaning you're aiming to make at least twice as much as you're risking. For example, if your stop-loss represents a $100 risk, your profit target should be at least $200 away. Why is this so powerful? It means you don't have to be right all the time to be profitable. If you maintain a 1:2 to risk to reward ratio, you only need to win about 34% of your trades to break even. If you win 50% of your trades, you're solidly profitable. This gives you a massive statistical edge over time. So always ask yourself before entering a trade, does the potential reward justify the risk? If the answer is no, simply pass on the trade. There will always be another opportunity. Let's also touch on portfolio level risk. It's not just about managing risk on individual trades, but also across your entire portfolio. One common mistake is to take on too much correlated risk. For instance, if you open long positions on 5 different tech stocks that all tend to move together, you're not really diversified. A bad day for the tech sector could hit all 5 of your positions at once. So, be mindful of how your positions are correlated. Try to diversify across different sectors or asset classes if your strategy allows. Also, consider your total risk exposure. Even if you're using the 1% rule on each trade, if you have 10 open positions, your total potential risk is 10% of your account. Be aware of how much capital you have at risk at any given time and make sure you be comfortable with that level of exposure, especially during volatile market conditions. Another advanced technique is scaling in and out of positions. This isn't for beginners, but it's a powerful tool. Instead of buying your entire position at once, you might buy a third of it initially. If the trade starts moving in your favor and confirms your thesis, you can add another third. This can reduce your risk if the initial idea is wrong. Similarly, when taking profits, you don't have to sell everything at your target. You could sell half of your position at your first target to lock in some gains, then move your stop loss to your entry price. This creates a risk-free trade on the remaining half, allowing you to potentially capture a much larger move if the trend continues. This method helps you lock in profits while still leaving room for more upside. Finally, the most important risk management tool you have is your own psychology. Fear and greed are the two emotions that destroy trading accounts. Greed makes you over-leverage or chase trades without a plan. Fear makes you exit winning trades too early or hesitate to take valid setups. How do you combat this? By having a trading plan and sticking to it religiously. Your trading plan should detail your entry and exit criteria. Your risk management rules everything we've discussed. It's your business plan. When you have a clear plan, you operate based on rules, not emotions. And a huge part of this is keeping a trading journal. Log every trade, your entry, exit, stop loss, your reasons for taking the trade, and how you felt. Reviewing your journal regularly is like watching game tape. It reveals your patterns, your strengths, and your weaknesses. It will show you where you read breaking your rules and help you build the discipline needed for long-term success. So, to wrap it all up, risk management is the bedrock of successful swing trading. Start with the 1% rule to protect your capital. Use proper position sizing to enforce that rule. Set intelligent stop losses based on technicals and never, ever move them in the wrong direction. Always aim for a favorable risk-to-reward ratio, ideally 1:2 or better. Be mindful of portfolio correlation and total risk exposure, and most importantly, control your emotions by sticking to a trading plan and learning from a detailed trading journal. Mastering these techniques won't guarantee every trade is a winner, but it will guarantee that you can stay in the game long enough to let your winning strategy pay off. Thanks so much for watching today. I hope you found these tips valuable. If you did, please hit that like button, and if you haven't already, make sure to subscribe and ring the bell so you don't miss our future videos. What's your number 1 risk management rule? Let me know in the comments below. Stay safe out there, and happy trading.